Welcome to Remember Me by Intervivos, the show about living life to its fullest, leaving a legacy, and deciding how you will be remembered. And now, your humble team of expert planners taking the legal world by storm.
Hi, welcome to Remember Me. This is the show where we talk about leaving a legacy, planning your future, and deciding how you'll be remembered. We have a special guest today, and we've been talking a lot about planned giving and about how you perpetuate a legacy through leaving for the causes that you believe in. But the traditional thing that most people think about when leaving a legacy is about the stuff, about the money, about the estate, right? And so we're going to dive into that a little bit. And our guest today comes from the Heartland Institute of Financial Education, and he's based out of Chicago, been in the industry for quite a while, Anthony Gurrieri. So, Anthony, thank you so much for joining us on the show. Tell us a little bit about yourself.
Well, thanks for having us on the show, here, Glenn. My name is Anthony Gurrieri, right? I've been actually with the Heartland Institute of Financial Education over now for the past 9 years. And I'm a certified financial educator, and essentially I'm an instructor for the Institute. And what we do is we provide financial wellness programs for companies, from big companies like, the Lockheed Martins of the world, to small church organizations. We provide financial wellness programs for them to help empower individuals and their families how to better plan for their finances, right? One of the biggest challenges with families out there, whether they are high net worth clients or just middle class, is their understanding of financial choices, like being able to make the right financial decisions. Just because you have a lot of money doesn't mean that you know how to spend that money properly. And so what we do is we focus on giving people the knowledge so they can make more informed decisions.
So, you said that just because somebody has a lot of money doesn't mean they know how to spend it well. We've treated this topic a couple weeks ago where a lot of times people receive large sums of money and then it just kind of goes through their fingers without having the right understanding. That can happen really easily. So one of the things we want to dive into today is, and I've mentioned this a few times, if you want to leave a legacy of money, it's really easy. Just go get a really big life insurance policy, right? And then you can leave a pretty large amount to your posterity, and even a modest estate can turn into a large estate if you do that. But a lot of times we think about the wealthy people and families that are out there, and we think, well, what use do they have for life insurance? So one of the things we're going to kind of dive into today is some of the strategies that the wealthy use in regards to leveraging life insurance. But Anthony, have you found that wealthy clients, high net worth clients, that they actually do use life insurance still?
I tell you what, the ones that understand the power of it, absolutely, they understand the leverage of it because it's the most economical way to create a large estate, do it in a tax efficient way, and provide a tremendous amount of liquidity if something is to happen to you. And at the same time, depending on how you set it up, you always have access to the money that you put into it. It provides a living benefit that's also there, and a lot of people don't understand that. And so, we've had 20 years, 10 plus years of strong economic market conditions, but I think if you just go back a little bit more than 10 years ago, we saw what an economic collapse can do to high net worth clients. In fact, the more money you have, especially if you're a growth investor, you tend to be very aggressive. You take big chances. Maybe you invest in real estate. You put a lot of money in the market. And most of us, let's face it, people are living above their means. And even people with high net worth clients, because the more we make, the more we spend. And so what's great about life insurance as an asset is it provides that guaranteed stability that, hey, if anything happens, this is what's going to go income tax free to my family. And then at the same time, you can always use that asset as leverage if you need cash, like Walt Disney, right? Back in the day when he needed some money, right? So the Rockefellers, right? There's been a lot of very wealthy families in American history that have used life insurance when they needed it. And so I think it's just about educating people so they understand the value of it, and that way they can use it the right way.
So I'm glad you brought up the examples of, Walt Disney, for example. There's been a lot of stories, famous people who have leveraged life insurance for maybe reasons that we don't often think about. But tell us a little bit about that story. Walt Disney used it for starting Disneyland. But how could he do that?
Well, basically he was trying to grow, and he couldn't get the capital that he needed. So he tapped into his life insurance policy among some other assets, and he used that money to finance the creative thoughts that he had, and put it into this team. And then the first story was created, and there goes Disneyland, and now we see it as this big empire today at Disney World. And so many people don't know, and especially the average guy out there doesn't understand that every success story has a beginning. And this is a great story of how life insurance was leveraged. Ray Kroc, McDonald's, did the same thing, right? I think it was he didn't take a salary or something for like 8 years. Well, he was able to tap into his life insurance policy and use that. And I see clients, I've been working with people for 21 years for all different levels of net worth, and they've been able to leverage that when they needed it without having to worry about a tax liability and cashing assets at the wrong time. I mean, perfect example is what happened in 2008, right? Depending on the type of life insurance account you had, real estate was down, right? Investments were down. I mean, it was a perfect storm. But depending on the type of plan you had, many of the plans out there would have provided you no principal loss, and you would have been able to still have that access to that cash. Because the last thing you want to do is access an investment, right? Liquidate an investment when it's down, right? It's because you're subjecting yourself to a sequence of risk return. And so when you have an asset that's stable and you can access it, doesn't matter what's going on in the economy. It really gives you a huge leveraging point and advantage.
So, as a business owner, access to capital is hard because a lot of times you have to have the credit, you have to have, an established business history, you have to be able to qualify for loans or that sort of thing. And a lot of times they get rejected. We hear on, Shark Tank all the time, people trying to get capital and they can't, right? And then, if they can't get capital, then they have to take on investors or they have to, somehow, look for it in other ways. But what you're saying is, Ray Kroc and Walt Disney are perfect examples of business owners leveraging life insurance as an asset to be able to fund the growth of their business. And so do you have any other things that you want to add to kind of how that strategy works or what somebody would look into if they were maybe curious about that?
Yeah, so basically one of the things that they should take into consideration is, for example, you have a business, right? And that business is usually, if you're building the business, or even if it's a successful business, there's usually there's a person, there's some key components of that, key employee, usually the founder. In this case, you looked at Walt Disney. Obviously, he was the brains behind all of it. Ray Kroc was the genius behind it, right? So with a business, if something were to happen to those people, that business, the chances of that business going forward goes down. So one thing is to have life insurance just to protect the business, right? As well as having life insurance to protect your key employees. You have a key employee, let's say your marketing representative, that's bringing in a tremendous amount of revenue. Well, if something happens to that person, how much money are you going to lose? It's hard to quantify that because you think about your growth rate, what revenue they're bringing in. So you want to make sure you insure it and say, what I like about it, hey, if nothing happens, well, great. Then what you can set it up to where it can build value in cash. And then that cash is part of the business's asset. And then you can use that money in the future. It can be taken out depending on how you structure it. There's different tax advantages you can use with it. And then there's also small businesses can leverage it a lot too, because you're a small business owner. A lot of times the money that you're making in that business, you're putting it right back into the business. So you may not have a tremendous amount of income coming in. You have a lot of write-offs, right? So you're not as concerned maybe about the tax liability now. But the goal, of course, is to make that business worth a lot of money at some point. So maybe in the future, turn around and you want to sell that business. Now, let's say you're a successful business owner, you sell for millions of dollars. Where are you going to park that cash? So actually, there are ways where you can use life insurance as a way to protect you, but then also create a huge window where you can dump potentially millions of dollars into it, and at the same time, make sure that asset continues to get tax-deferred and tax-free growth. So there's a lot of strategies. I think the most important thing is figuring out your economic value to the business and then figuring out the best strategy to finance those policies and then take into consideration the distribution. A lot of times we look at, hey, we want to create wealth, right? All about creating wealth, but what about the distribution side of it? That's where the taxes tend to come and get you. So, everyone wants pre-tax and tax savings, but we have to think about the distribution as well as passing that money on. right? That transfer tax potentially.
Yeah, definitely. So, tax planning is a big component of this. Succession planning for business owners, right?
Yes.
After the break, we'll get back to kind of this concept of, instead of having to go to the bank, you can be your own bank. You can set up your own family bank or your own bank for your business in the case of, some of these stories you've shared. Anthony, before we break, tell us if somebody wanted to get a hold of you to be able to get more information, how do they contact you?
They could call me directly at 630-730-9650. They can also go to my website, Anthony Financial, www.anthonyfinancial.org. So once again, a World Wide Web, anthonyfinancial.org. You can also reach me there and send me a message.
Awesome. Anthony Gurrieri from the Heartland Institute of Financial Education here on Remember Me, and we'll be back in just a second. Welcome back to Remember Me. This is the show where we talk about leaving a legacy and deciding how you'll be remembered. And we're talking with our guest all the way from Chicago, Anthony Gurrieri, who's with the Heartland Institute of Financial Education. And we've been talking a little bit about, what families can do. And, before the break, we were talking about businesses and business owners in particular, but what they can do to be able to leverage assets to leave in perpetuity, and especially through life insurance. So, Mike, we were talking, a little bit about during the break about the concept of a family bank. And, why would somebody want to do that sort of thing where you're not just leaving it to, the kids or to a specific person, you're leaving it to continue on and on.
Right. And, using a family bank, when I've had my sister that she's had to borrow from the family, and it's been things like that. It's been able to pay it all back. But, being able to be the bank so you don't have to actually go out and have to, go through your whole life history just to make sure that you qualify for it, because the bank doesn't loan you unless you don't need it, right?
And sometimes, making it official, because when mom or dad dies and this stuff isn't written down, then it can be a nightmare sometimes.
Right. And, and continuing on for generation after generation. It's not just mom and dad and then the kids. It's their kids and their kids and their, perpetuity, like you said, keep it going forever. And then putting those ethics in there to make sure the kids don't spend it the wrong way, Not the spend. You can put the spendthrift clause in.
Yeah, in fact, Anthony was just sharing with us during the break a story of a client of his that had that situation, right, where some of the family turned out okay, some of it didn't.
Yeah, it's a natural human condition, especially when you are in the first generation of creating wealth, right? Let's say you're that first generation that goes from rags to riches. And now what do people generally do? They immediately want to give their kids the best life. What happens? And all that hard work they did to earn it, if their kids don't understand the principles, they're just going to go ahead and burn that money. In fact, there's a saying, first generation makes the money, the second generation spends it, and the third generation loses it. And so we literally have a friend, that's exactly what's going on. They had a big family, and the older siblings got a chance to see what life was like before the wealth. And so they had a more value and appreciation. They had the work ethic. The younger ones grew up in a bubble in one of the wealthiest suburbs here in the Chicagoland area. And so their friends were in that boat. And so what reality was to them was, fancy luxury cars with no work, And so just because you have money, that's not necessarily going to help make you be happy, right? It can provide financial security. But if you don't have purpose, that creates a problem. And we live in the United States. No matter how much money you make, you can burn it off. There's always a bigger house. There's always a nicer car. There's always something. You can go by plane. And these things happen. That's why when you look at like the Rockefeller family, they have generations of wealth because one of the tools they used was life insurance. Right? And so they created that, right? The fastest way and the most economical way to create an estate through life insurance. And then when you pass on, if you set it up properly with an attorney, you set up a trust, You can set it up to where it goes estate tax free, depending on how big the family is, right? The big the net worth is. And then that can go on to the next generation. And then you can put all kinds of different stipulations in there, right? Like, well, you guys know, you're the attorneys, right? So how to make sure that that money gets spent wisely and that they have the proper education. But instead of creating a legacy of challenges, you're going to create a legacy of wealth. And that's great. And that's why I love the life insurance component from that point of view.
Exactly. So a lot of times people think that, you set up your plan and then when the money's all gone, the money's all gone, and you're going to leave it to the next generation and they're going to spend it, or maybe you leave it, for the grandkids and great grandkids, but when the money's gone, it's gone. But it doesn't necessarily have to be like that, because if you have a death benefit through a life insurance, now there's a new influx of money, and you could do that as many times as you want to. So This brings up the concept of that family bank, right, where it's kind of, one central place that people within the family can rely on with guidelines of, what the money's used for and how it's paid back and who's in charge of controlling that. But what are some of the advantages that, maybe even families that aren't wealthy or high net worth that they might find in a structure like this that maybe they haven't considered?
Well, one of the things about life insurance, right? So a quick education on that. There's term life, right, which is a temporary insurance. It's like renting. And then there's permanent, which is like owning, right? The permanent gives you equity. And there's several forms. There's whole life. There's index universal life. There's variable universal life. But you take, for example, index universal life, right? And every company's different. They all have their advantages and disadvantages. So you really got to study it and you got to work with someone that knows how it works. But generally, the idea about it is that I can put money aside, right? Let's say, let's use $1 million as an example. It's not a lot, but let's say someone buys $1 million plan. Well, the minute they make that first premium payment, they get accepted. Now their net worth is, their estate is at least $1 million. If anything happens, it's going to go tax free. But here's the best part: no one wants to die early. We all want to live a nice long life, right? We want to pass away in our sleep, right? With no medication and no pills and no machines, right? That's the ideal. It would be perfect, right? Live a great life, then one day you don't wake up and you're like 90-something years old, right? Whatever it is. The reality is things happen, right? And so that's where the life insurance living benefit comes in. So now it builds up value, cash value. So now let's say you need some money, right, for your business, for college funding, for retirement supplement, there's a challenge in a family, right? You can tap into that account, right? We call it cash value. The concept is bank on yourself, right? Because everyone thinks, hey, I got to go to the bank to get the money. But conceptually, you can go to your policy, your money. You can borrow from yourself. In some cases, zero interest rate. In some cases, you can earn money, depending how it's structured. In case you just pay a little bit. I mean, there's a lot of different structures out there, but the bottom line is when you go to get that money, you don't have to pay any taxes on it. You don't get a 1099, and nobody even knows you're taking that money out. In fact, one of the things I love about life insurance is that no one knows how much money you have. The only people that know is the insurance company. The government certainly doesn't know that it exists. You can have $10 million in your cash value. It's not reportable anywhere, right? The only time you have to worry about reporting it is maybe when you pass it on, if it's above the estate tax exclusion, so on and so forth. So it's one of the best kept secrets out there in planning. And I work with, high net worth clients, but I think it's an excellent vehicle for that middle to upper middle market because once again, they're even more valuable to their family. It's from an economic point of view, where their economic value is even bigger because they don't have all those assets.
Well, and we've talked about this before, but one of the things that Hife does is also you mentioned life insurance not having to be reported. Even when you're trying to qualify for financial aid, your kids are trying to qualify and that sort of thing. Life insurance doesn't have to be reported. Imagine if you have this family bank set up, and instead of taking government student loans, you're taking loans from the family bank and paying it back at little to no interest, or maybe having part of it not have to be paid back and part of it that would be paid back at an extremely low interest rate, but to be able to perpetuate that, pretty awesome. So tell us a little bit. I know you do some planning with families for financial education as well.
So there are when it comes to college planning, right? Number one, that's a concern I've noticed even with all levels of net worth. Because let's face it, I mean, you're looking at cost of college right now. We have University of Chicago here. We've got Northwestern. Those are your high-level elite schools, over $70,000 a year. I don't care what you make. That's a lot of money. We're talking about bachelor's degree. And if someone's going to go there, they're probably going to be a professional. Maybe they're going to go and get their doctorates or something, whatever, right? It's good. You're talking about hundreds of thousands of dollars. And so the debt's up to $1.5 trillion right now. So one of the things that you want to know how to do is reposition your assets so they're not included, right, in your FAFSA or your CSS profile where you have to list those assets. You literally could have 7 figures in your bank, right, your own personal bank, and that's cash value policy. And it's not disclosable as an asset, so you can tap into it. It gives your kids a stronger probability that they're going to get scholarships. They may not get government aid if you're wealthy, but there's a stronger probability they may get merit-based scholarships and so on and so forth. So the traditional plans have pros and cons. Once again, is another way to basically reposition your money where you don't have to disclose it. And the big thing here in Illinois, I don't know the laws out by where you guys are at, but in Illinois, any money in this bank, right, or it's cash value as we call it, it's protected from creditors as well. So, I mean, things happen. People get sued. I mean, people lose businesses because their kid made a mistake. And that money cannot be touched, right? Some of the most famous people have done some bad things. They still had money because they put it in and protected it in some type of insurance program. And most of the time it's life insurance or some type of annuity.
Exactly. And you know, that's a great point because, you know, especially we've talked about this as well. But when you get to higher net worth and when you have, you know, more of a legacy that you're leaving, maybe it's not even your legal problems that could affect it. But when it gets to the next generation, right, lawsuits are a big risk. So asset protection planning is definitely another great reason to have a structure like this set up. And, you know, life insurance is also something that's protectable as an asset. So, yeah, definitely. So, again, you know, before we broke, you shared with us how to get in contact with you, Anthony. But tell us one more time, if somebody were interested in learning more, how do they get a hold of you?
Okay, they can contact me directly at my cell phone number, 630-730-9650, 630-730-9650, or they can go to my website at www.anthonyfinancial.org. So it's anthonyfinancial.org, and they can send me an email or they can call me from my numbers on there as well.
Awesome. Thank you so much for joining us. Thanks for joining us on Remember Me. We'll see you next week.